Picture this for a second. It's Wednesday afternoon. You're sitting at your desk eating a sad desk salad that costs $14. Your email is full. Your phone buzzes with a credit card notification, and your stomach kind of drops because your paycheck hit yesterday and somehow most of it is already gone. Rent, car payment, groceries. Subscriptions you forgot about, a little bit of takeout because you were too tired to cook, and suddenly that $4,800 monthly paycheck feels more like $400. Now here's the uncomfortable question nobody likes to ask. What if the average financial life is actually a trap? Not because people are lazy, not because they're bad with money, but because the math itself is brutal today. We're going to break down 7 money statistics about the average person that almost nobody talks about. And once you see these numbers, you might never look at your paycheck the same way. Again, some of these are shocking, some are uncomfortable, and one of them explains why most people stay financially average for their entire lives. Let's talk about it. Hey everyone, my name is Jake, and on this channel, I break down the real math behind money, not the fluffy Instagram advice, not the just stop buying coffee nonsense, but the actual numbers that determine whether someone builds wealth or stays stuck financially. Because here's something I realized a few years ago that honestly kind of messed with my head. Most people aren't failing with money because they're irresponsible. They're failing because the system they're following is mathematically average, and if you follow the average financial path, you usually end up with average results. Now that might sound obvious, but wait until you see the numbers. For example, the average American savings account has less than $4,500 in it. Nearly 60% of people cannot afford $1,000 emergency expense. The median retirement savings for people in their 40s is shockingly low, but here's the important part. You don't want to just show you depressing statistics. Instead, we're going to break down what these numbers actually mean, why they happen, and more importantly, how people who build wealth live differently from the average person. Because wealth isn't random. There are very specific behaviors, math patterns, and psychological shifts that separate people who stay stuck from people who gradually move above average financially. So, in this video, we're going to walk through 7 brutal money stats about the average person, and by the end, you'll understand why the first $10,000 is the hardest money you'll ever save, why the average car payment quietly destroys wealth, why most people accidentally trap themselves in a lifetime of financial mediocrity. So, if you want to understand the real math of money and wealth building, make sure to hit that subscribe button, all right? Let's start with brutal money. Stat number 1, according to data from the Federal Reserve, roughly 60% of Americans cannot cover a $1,000 emergency with savings. Think about that for a second. Not $10,000. Not a massive medical bill, $1,000 now. Most people hear that statistic and immediately think, well, yeah, inflation is crazy. Everything is expensive. And that's true, but the math behind this problem is actually deeper than that. Let's imagine 2 people. Person A earns $4,500 per month after taxes. Their monthly expenses look something like this: rent, $1, $600 car payment, $520 groceries, $450 utilities and internet, $250 insurance, $200 phone and subscriptions, $120 gas and transportation, $200 eating out and small spending, $350 total. Monthly expenses, about $3,690. That leaves about $810 left over. Sounds decent, right? But here's where reality kicks in. Life isn't stable. Expenses fluctuate, random costs pop up, travel happens. Friends invite you out, the dog needs a vet visit, so what? actually happens is that most people slowly spend that margin and suddenly the $810 buffer disappears now. Imagine an emergency hits car repair. $1,043 at single expense wipes out savings instantly. This is what I call the financial iceberg problem. From the outside, someone's life looks stable, good job, decent salary, nice apartment, but underneath the surface, their financial structure is incredibly thin, like an iceberg floating in warm water. It looks solid until it melts. And the real danger here isn't just emergencies. The real danger is that when people don't have emergency savings, every problem becomes debt, car repair, credit card medical bill, credit card broken laptop, credit card. Now imagine that $1,043 repair goes on to a credit card at 24% interest if someone pays $100 per month. It could take over a year to eliminate that balance. And suddenly that $1,043 repair becomes $1,200 or $1,300 total paid. That's the trap. So the real lesson of this statistic isn't just save more money. The real lesson is this: your first $1,000 in savings is not about wealth, it's about stability. It's the difference between absorbing problems or financing them with debt. The average car payment in the United States is now around $725 per month for new vehicles. $725. Pause there, because when people hear that number, they usually think, okay, that's expensive. But cars are just expensive now, right? Wrong, because the problem isn't the price of the car. The problem is what that money could have become. Instead, let's run a simple scenario. Imagine someone pays $725 per month for a car loan. That's $8,700 per year. Now, let's imagine they do that for 6 years, which is the average loan length today. Total spent about $52,200. But here's the twist: cars depreciate, meaning after those 6 years, the vehicle might only be worth $20,000 or less. So someone has effectively turned $52,000 of cash flow into an asset worth less than half that amount. Now let's compare that to a different scenario. Instead of putting $725 into a car payment, imagine someone invested that amount into a basic index fund earning 8% annually. After 10 years, that investment could grow to about $131,000. After 20 years, that same habit could grow to $425,000. Think about that one. Financial decision, repeated monthly, could determine whether someone has a depreciating asset or nearly $500,000. I call this the silent wealth drain, because it doesn't feel dramatic. No crisis happens. No one screams, "You're ruining your future." It's just a quiet monthly payment that slowly redirects your financial future away from investing. And psychologically, cars are one of the hardest financial decisions to make rationally, because they represent status, convenience, identity, and comfort. But financially speaking, cars are like renting a lifestyle upgrade, and the average person keeps upgrading that lifestyle every few years, which leads to a cycle of permanent payments, and that cycle quietly prevents the next milestone most people desperately need. Which brings us to the third brutal statistic. Okay, this next number is honestly one of the most shocking statistics in personal finance. According to retirement data compiled by Vanguard, the median retirement savings for Americans aged 40 to 44 is around $28,000. Let me repeat that: $28,000. For someone potentially halfway through their working life. Now, at first glance, $28,000 might not sound terrible. Let's do the math. Imagine someone plans to retire at 65. That gives them roughly 25 years left to grow that money. If they leave $28,000 invested and earn 7% annually, It grows to roughly $152,000 by retirement now. Ask yourself a simple question: could someone live off $152,000 for 20 to 30 years of retirement? Probably not, and this is why so many people rely, almost entirely, on Social Security payments later in life. But here's the psychological trap: most people don't feel behind financially because they compare themselves to friends who are also financially average, like being in a room where everyone is running a marathon, but nobody has checked the distance. Everyone assumes they're doing fine because everyone else is moving at the same pace until someone finally checks the map and realizes the finish line is still 20 miles away. This is what I call the comparison illusion. People judge financial progress by social comparison, not by mathematical reality, and mathematically speaking, retirement savings requires time and consistency. Someone investing $500 per month at 8% for 30 years could accumulate roughly $745,000. Increase that to $800 per month, and the total becomes over $11 million. But if someone waits until their 40s to start, the math becomes brutally difficult, which brings us to the next statistic, because the reason many people delay investing is tied to something even more fundamental: income stagnation. All right, this brings us to brutal money stat number 4, according to data collected by the U.S. Bureau of Labor Statistics. The average household spends roughly 70 to 80% of their income every single year. Now, at first glance, that might not seem shocking. People earn money and they spend it. That's life. But the real problem is what that spending does to long-term wealth building. Let's break it down with some simple math. Imagine someone earning $70,000 per year after taxes. Their take-home pay might be around $4,400 per month, or roughly $52,800 annually. Now, if they spend 75% of that income, that means about $3,300 per month goes to living expenses, housing, food, transportation, insurance, subscriptions, random purchases that slowly add up. That leaves about $1,100 per month. Now, in theory, that sounds like plenty to invest, but here's the reality most people experience: unexpected expenses creep in, vacations happen, holidays arrive, friends get married, something breaks in the house, and slowly that $1,100 cushion shrinks to maybe $300 or $400 saved per month. Now, let's compare two people. Person A saves $300 per month, invested at 8% annually. Over 30 years, that grows to about $447,000. Now meet person B, who saves $900 per month, same investment return, same timeline. After 30 years, person B ends up with about $134 million, 3 times more wealth, same income, same timeline, different spending behavior. I call this the lifestyle creep ladder. Every time someone gets a raise, they climb one rung higher: better apartment, newer car, more expensive vacations. Here's the brutal reality: if spending grows at the same speed as income, wealth never accelerates. You stay financially average forever, because wealth isn't created by income alone. It's created by the gap between income and spending, and that gap is what most people unknowingly eliminate, which leads to the next brutal statistic. Because even when people do save money, something else quietly eats away at it. All right, let's talk about a statistic that almost nobody discusses outside of financial circles: impact of investment fees. According to research from Morningstar, the average investor pays around 1% in annual investment management fees. Now, 1% sounds tiny. 1% feels harmless, but when you apply it to decades of investing, the numbers become brutal. Let's run a realistic scenario. Imagine someone invests $600 per month into their retirement account for 35 years without fees, assuming an 8% annual return. That portfolio grows to roughly $113 million. Sounds pretty good. Now imagine the investment charges a 1% annual fee that reduces the effective return to 7% after 35 years. That same portfolio ends up around $845,000. That's a difference of almost $285,000. Think about that for a second, a single percentage point. Quietly erased nearly $250,000. And here's the crazy part: most people never notice because fees don't feel like a payment. They're automatically deducted inside the investment account. It's what I call the financial termite problem. If termites destroy your house, you notice immediately, but financial termites? They chew away slowly, silently, for decades until one day you open your retirement account and realize there's hundreds of thousands of dollars missing compared to what could have been there. This is why many long-term investors prefer low-cost index funds with fees around 3% to 10%. Because when you stretch time over 30 or 40 years, every fraction of a percent matters, but even fees aren't the biggest wealth destroyer, because the next statistic explains something far more powerful. Time itself. Okay, this one might be the most brutal statistic in the entire video. The cost of waiting to invest. Let's compare two people. Person A starts investing at 25 years old. They invest $500 per month. They continue until they reach 65 years old, assuming an average 8% annual return. Their total retirement savings could grow to about $175 million. Now meet person B. Same monthly investment, same return, but they start at 35 instead of 25. That's only a 10-year delay. Their final retirement balance? About $745,000. Think about that difference. One decision, waiting 10 years, cost them over $1 million in potential wealth. Why does that happen? Because of compound growth. Money invested earlier has decades longer to multiply it. It's like planting trees. If you plant a tree today, it grows for 40 years. Plant it 10 years later, and you lose a decade of growth. I call this the time multiplier effect. Early money works harder. It compounds longer. It builds momentum, and once compounding starts accelerating, something interesting happens. Your investments begin producing more money per year than your job salary. But most people delay investing because they feel financially unprepared. They think, I'll start investing when I make more money. But the reality is the opposite. Earlier you start, even with small amounts, the easier the math becomes, and the final statistic explains the most important difference between average people and wealthy people. All right, here's the final brutal statistic. Many financial studies have suggested that the average millionaire develops around 7 income streams over time. Now, before you imagine some complicated business empire, let's break down what that actually means. These income streams often look like primary job income, retirement, investment returns, rental income, side businesses, stock dividends, capital gains, royalties, or digital products. But here's the important detail. Most millionaires did not start with 7 income streams. They started with 1, then slowly added more over time. Let's imagine someone earning $70,000 per year from their main job. Then they start a small side income, earning $500 per month. That's $6,000 per year. If that income gets invested at 8% annually for 25 years, it could grow to around $440,000. Now imagine adding a second income stream later, maybe dividend investments, paying $300 per month. That's another $3,600 per year over decades. Those streams compound into serious wealth. I call this the income ladder. Each stream becomes another rung that lifts your financial life higher. And This is why wealthy individuals often focus on building assets, not just earning salaries, because salaries are linear, assets are exponential. When you combine multiple income streams with compound investing, something powerful happens. Your financial life slowly moves above average. So, let's step back and recap the 7 brutal money statistics we talked about today. First, 60% of people cannot cover a $1,000 emergency. Means most financial lives operate on extremely thin margins. Second, the average car payment of $725 per month quietly drains hundreds of thousands of dollars of future wealth. Third, the median retirement savings in the early 40s is around $28,000, which simply isn't enough to support decades of retirement. Fourth, the average person spends around 70 to 80% of their income, and that spending pattern slowly eliminates the gap required to build wealth. Fifth, investment fees as small as 1% can quietly erase hundreds of thousands of dollars over time. Sixth, starting to invest 10 years late can cost over $1 million in lost compound growth. And finally, most wealthy individuals gradually build multiple income streams, while the average person relies entirely on one job. Now, here's the important insight: none of these statistics means someone is doomed financially. They simply reveal the mathematical reality of average financial behavior. If you follow the average path, you'll likely experience average outcomes. But the good news is that wealth isn't built through one giant decision. It's built through small habits repeated for decades: saving earlier, investing consistently, avoiding lifestyle inflation, building income streams. Those tiny shifts slowly move someone from average to financially independent. So, now I'm curious, which of these statistics shocked you the most? Was it the $1,000 emergency problem? The car payment trap? Or the fact that starting just 10 years late could cost over $1 million? Let me know in the comments, because understanding these numbers is the first step toward escaping them. And if you found this breakdown helpful, make sure to subscribe to the channel. Every week, we break down the real math behind money, wealth building, and financial independence, not the surface level advice, the real numbers. Because once you understand the math, something interesting happens. You stop feeling confused about money. Start seeing the patterns. You realize wealth isn't magic, it's math. And once you understand that math, you can start making decisions that slowly move your financial life above average. Thanks for watching, and I'll see you in the next video.